Self-managed super is one of the biggest segments of the superannuation industry. But in the search for higher returns in the current low interest rate environment, another worrying trend is developing. Earlier this year, we told you about the rise of property spruikers in the self-managed super space. Tonight, Chief Reporter Andrew Robertson examines the growth in the use of derivatives.
As the name suggests, derivatives are derived from a physical asset like a share or commodity. For a small outlay, investors get exposure to a much larger amount of that physical asset.
It's like splitting an atom. If you split it one way, you've got energy, you've got heat, really useful stuff. If you slightly split it a different way, you've got a bomb, and that bomb can explode in your face.
And when that happens in super, it's retirement dreams that are blown up.
If you go out and put $1,000 on the first race, the worst you can do is lose $1,000. If you put $1,000 into options, you can lose $10,000, $20,000.
The Australian Taxation Office is the regulator of self-managed superannuation funds. Its figures show the use of derivatives such as options and instalment warrants nearly tripled from 2010 to 2012. In that period, the Reserve Bank has nearly halved the official cash rate. In a former life, Tim Mackay was a derivatives trader in London, and he's really concerned by what he's seeing.
The only way you can get high returns is by taking high risk. Risk and return go hand in hand. So there's no easy way of getting those returns apart from taking higher risk.
Even those who know can lose out with derivatives. As one of Australia's most high-profile financial planners through his weekly columns for Fairfax Media, Noel Whittaker has found derivatives a painful experience.
They were doing very well for a while, but the moment the market started going up and up and up, the losses started going up, and I have now lost more to date than I made prior to that.
Not everyone is against the use of derivatives in super, though.
Derivatives have always been used for speculation, but what we're talking about is not speculation. We're talking about strategies that can either reduce the risk in a portfolio or enhance the yield in a portfolio. Peter Kennedy's website actively encourages the use of derivatives to achieve those goals, but his clients are wealthy, sophisticated investors, and even he concedes most self-managed super funds should stay well clear. You probably need a reasonable amount of expertise and experience to use them properly, particularly when you're considering a self-managed super fund, which is normally expected to be managed on a very conservative basis. It was derivatives that gave us the global financial crisis, despite the vast experience and expertise available in the world's biggest banks, which is why the rapid growth of derivatives in self-managed super funds is a major concern.